Hello, folks. It is Monday, February the 12th. I have been in transit, making some life changes, did another cross-country move. I had been basically hiding out in the woods, waiting for the world to end, and decided that that's not how I wanted to live my life. And so anyway, I'm back in Southern California. Um, in this video, I'm going to talk mostly going to focus on interest rates. Let me share my screen here and we will get going. So it's a dramatic image there. Rising interest rates. Um, just background, this is the San Jacinto Mountains. And so as I'm driving around this part of Southern California, this is part of the backdrop, is seeing these snow-capped mountains. And, Southern California has been my home for more than 30 years and have never had this view. I've never lived in the LA area, which is where I'm hanging out right now. And so this is different for me. It's very dramatic, very beautiful, looking off on the horizon and seeing snow-capped mountains. In particular, in Southern California, blue skies and sunshine and snow-capped mountains. It's a dramatic contrast, and very different from being in upstate New York. So upstate New York, kind of gray and dismal if you're used to blue skies and sunshine. But anyway, enough of that. I'm guessing that you're probably, this was a week, 2 weeks ago, Evergrande in China. This is one of the largest real estate developers in China. They were ordered to liquidate the business. And of course, if we look at this particular chart, let me get that image out of the way. I've been talking about Evergrande all the way, since December of 2021, when they first defaulted on $300 billion in debt instruments. And of course, those debt instruments are not isolated within China. We've got European investors, American investors, lots of people and institutions have invested in this Evergrande debt, which they defaulted on. And then, back in August of 23, the company declared Chapter 15 bankruptcy. And Chapter 15 is when you are an international company. Chapter 15 addresses the fact that your financial liabilities are spread across the world. They're global, not isolated to China again. So, and then now here's the January 29. This is the most recent event. Evergrande has been ordered to liquidate. And so now any of these institutions that have been holding on to this Evergrande debt that, they defaulted on, they may have been holding on to it hoping that they would, at least get pennies on the dollar at some point. With a liquidation, it is quite unlikely that any non-Chinese investors will see a single penny of their investment back. That basically the secured creditors and Chinese creditors to Evergrande will get paid first if there is any if there is any money coming out of the liquidation. The primary investors, which almost certainly going to be Chinese, they'll get paid first. And if there is money left over, it may get parceled out to European, American, other Asian investors. But so anyway, the reason I'm talking about Evergrande is because, as I've stated numerous times, I believe that this default was the trigger this was the first step in the global collapse of debt instruments. And of course, that collapse is ongoing. Now, one of the things I was reminded of as I was preparing for this video is that trends in the financial world and events in the financial world, they tend to take longer than we think they would or should, and certainly take longer than we'd like them to take. You know, here, December 2021, here we are more than 2 years, just over 2 years later, and this issue is still unwinding after 2 years. And so anyway, that's one of my points in this video, is that trends in the financial world take longer than people tend to think they will or expect that they will. So, and this global debt collapse is continuing. Now, in my opinion, there are a few ways that this collapse may play out. Now, one of the ways, and it's what we're seeing here, is that the central banks, in an attempt to prevent the collapse or, you know, prolong the collapse, that they will continue raising interest rates in an attempt to attract legitimate investors into their debt instruments. That, you know, maybe if nobody's interested in investing at 5%, well, if we take interest rates to 7%, maybe we can sell some of our debt instruments. Maybe it'll take 8%, maybe it'll take 10%. But anyway, that's one of the options, is that central banks could continue raising interest rates. Now, another option is that the central banks could go back to openly acknowledged quantitative easing. And I say openly acknowledged because, you know, the primary function of central banks, this is not what they would tell you, but it is what it is to expand the amount of debt in the world. I mean, all of the countries have fiat currencies, which by definition are debt-backed. And so the way you manage a debt-based currency and financial system is, you know, it's basically continual expansion of that debt. But for them to continue expanding the debt system, the fiat currency system, they either need legitimate investors in their debt instruments, or they have to basically just start printing money to buy their own debt instruments, which, you know, that's what banana republics do. But it appears that's one of the things that's potential at this point, is that we're basically going to go back to openly acknowledged quantitative easing. Another factor that suggests that will be the road taken is that here in 2024, we've got elections not only in the United States, where the US Fed is the operative central bank, but throughout Europe and other areas of the world. We've got significant elections that will happen this year. And of course, the politicians, they want the economy to look good. They want interest rates to be low. They certainly don't want anything collapsing on their watch. And so anyway, that's two of the possibilities I see going forward. Rising interest rates in an attempt to attract legitimate investors to debt instruments, or openly acknowledged quantitative easing, a return to quantitative easing. And of course, if they go down that route, quantitative easing, the amount of money that they will have to print is, you know, here just in the States alone, in my opinion, is 10 to 12 trillion dollars that basically they're just going to run off the printing press use that money to buy debt instruments. Some amount of that money will get pumped into the economy, which will feed inflation, which pushes interest rates higher. Anyway, we're kind of in a downward spiral, doom loop, call it what you will. We're not in a good point. We're not in a good point at you know, at this juncture. So anyway, one of the interesting things in this chart, besides the new event, which I've added here, that's the Evergrande being ordered to liquidate, is the fact that interest rates had kind of topped out and were doing this sideways consolidation for 5-6 months there, and then we got a break higher, and now for the past what's that, 4 months or so, the central bank, certainly the U.S. Fed, has been managing expectations with blarney, bullshit, trying to convince investors that they're not only going to pivot on their rising interest rates, that they were going to pivot back to lowering interest rates, and that we would have as many as 6 interest rate reductions in 2024. And so, pumping that narrative, which of course, again, it's all bullshit, just a narrative, they managed to get interest rates to drop for several months. And interesting, as a technical analyst looking at this chart, it appears to me that basically we had a breakout. So consolidation, breakout, pull back to the breakout level. And now this month, February, certainly looks like interest rates are finding support at the breakout level and headed higher. And that's that behavior is common to breakout patterns. Breakout, pull back to the breakout level, head higher. And so some traders who trade breakout patterns, basically there's 2 ways to play a breakout. You can buy the breakout itself, or you can wait for the pullback and then buy the upturn. Once the pullback is complete, buy the upturn with the expectation that the trend will continue. If we look at some other stuff on this chart, obviously MACD is in bull mode, with both indicator lines above the 0 level of this indicator. And that suggests that the primary trend in interest rates is to the upside, higher interest rates going forward. And again, just to reiterate, I believe that is the natural trend, is for higher interest rates, unless we go back into a quantitative easing, openly acknowledged quantitative easing. Another big picture chart. We've looked at this chart before, obviously. And the point I want to make with the big picture is, if you are a short-term trader, you enjoy trading the financial markets, you want to make money trading the financial markets, it's okay to focus on the news. Understand that the news at this point, they're just pushing narratives. It's all BS. It's all narratives. It's not factual. It's but you can make money trading the news if that's something you choose to focus on. But don't get duped. If you're investing long term, don't get duped by this narrative. The short term, the talking heads coming out and saying that they're going to lower interest rates, much less that there'll be 6 interest rate reductions in 2024. Don't get duped by that stuff. It's just narrative. It's BS. The big picture, in my opinion, is what we're looking at in this chart. We've had a downtrend in interest rate for 40 years. We had a substantial breakout back in 20, I'm in the way, and that picture keeps getting in the way. Back here in 2022, we had a break higher. Clearly, interest rates have broken out of this 40-year downtrend, and they are headed higher. And in my opinion, will continue heading higher. And as I've said in multiple videos before, trends in the interest rate markets, the debt instrument markets, they're multi-decade. They don't last just for months or years. They last for decades. And we see that here. That's 18 years of rising interest rates. And so when we see a definitive breakout, that's not a tentative move. You can't look at that and say, oh, that's just a little pop higher, they'll pull back. It's like, no, there ain't no pulling back from this. This was interest rates breaking higher, unless the central banks jump in and do something dramatic. In my opinion, interest rates will continue heading higher. So again, point being, focus on the big picture. Don't let yourself get duped by the narrative, the short-term news that we are continually bombarded with, just a narrative. In this chart, we're showing the yield curve, or the interesting part of this chart is the yield curve, and the fact that after the yield curve turns back up and rises above the 0% level, that's when we tend to see recessions. And so, again, based on the narrative, the United States economy is not currently in recession. You'd certainly look at some factors that would suggest that we are in recession, and that the U.S. economy is in a world of hurt. And certainly that's my opinion. But that's not the official narrative, and currently they're managing the financial markets to make it appear that we are not in recession. I've made the point before that if we look at the size of these dips, at the periods where the yield curve drops below 0, the bigger these drops are, the more pronounced and prolonged the subsequent recession tends to be. And based on that idea, we're working on a doozy here, that at some point, when the yield curve pops back above 0, if it ever does, I mean, we're at an interesting juncture in the world of central banking, fiat currencies, etc. We're baking the cake for a massive recession based on historic trends. And so anyway, I just wanted to take a look, share this chart with you. One of the things to keep in mind in regards to recession and are we in one, are we not in one? Recently, we got a GDP report. Last week or the week before, they reported, BLS reported GDP, and it came in hot. And so based on GDP, you would assume, or most people would assume, that, hey, that's a strong economy. If you dig deeper, what you find out is that included in that GDP is a whole bunch of financial machinations. And in particular, what I find particularly poignant at this point is that the $90 billion worth of financial aid that it appears we're about to send out into 2 different areas of the world that I won't mention, that $90 billion will get added into US GDP as if somehow it contributed to the strength of the US economy, that borrowing that $90 billion into existence and then doling it out to other countries, that somehow that helps the US economy. And so anyway, GDP is interesting. And through financial machinations like GDP, they are currently managing the appearance of the US economy, not the reality of the US economy, but the appearance of the US economy. They're able to say that the US economy is strong. It's not. As we've seen in the last 2 weeks or so, the banking sector is back in the news. We've had, let me pull up, it's new NYCB. Let me pull up that chart. I wasn't thinking. Let's see, it's New York, this Community Bank Corp. I wasn't thinking of the banks. No. So they had a big tank. We're looking at the weekly time frame, and so this was 2 weeks ago that we got this big drop, big volume. So anyway, banks are in the headlines again, clearly in trouble. And this is just the latest, the most recent bank to have problems or challenges in the stock market based on their financial soundness, which of course plays back into the health of the debt instrument markets, the bond markets. The banks are all loaded up with debt instruments that are not worth what they paid for. One of the ways they're managing that issue is through this bank term funding program, which is supposed to end March 11. That's basically a month from now. So a month from now, this lending facility is supposed to end. In my opinion, it won't, because there's currently $165 billion worth of, I've got to, let me pause this video, folks. I've got landscapers right outside my door. Okay, I apologize for that interruption. I'm currently living in a hotel, and this is not not the computer I'm used to doing these videos on. So anyway, bear with me. I hope that you will. So this bank term funding program, there's $165 billion that the Fed has loaned to banks. If they end this program, the banks would have to pay that money back. And of course, they don't have $165 billion to pay back, which suggests that the termination of this lending program would exacerbate or contribute to further collapse of the banking sector. And so anyway, we'll find out a month from now what they do with this lending program. One of the articles I've seen in the last couple of weeks, the banks have figured out how to arbitrage this facility, which is one of and the article was suggesting that that's one of the reasons that the Fed will terminate the program, is because they don't like the idea that banks are using this lending facility as an arbitrage opportunity. So anyway, that's all I wanted to talk about. Well, I got a lot more to talk about, but I've been babbling for long enough. I feel like I've been rambling, but hopefully you'll find some value in this video, and as I get back into the swing of doing regular videos, they will become more better. So have a great day, folks, and I will talk to you soon. Let me terminate this in